Hello and welcome back to Spicy Takes and Tax Breaks, where we mix strategy, sarcasm, and the stuff the IRS wishes that I would really just shut up about. I'm your host, Aubree Denekamp, and I'm your tax strategist, numbers therapist, and the woman who will absolutely remind you that your life choices do have tax consequences, typically liability-wise, and penalties added to it. I wish I did, but truly, guys, I don't make the rules. I just find a way to make them work for you, whatever that looks like in your life. And today we're diving into the year-end checklist. Please don't roll your eyes yet. This is not the snooze fest version that your accountant typically emails you in Times New Roman. This is the go ahead and open up your notes app because you're about to be excited and you're going to save thousands. I'm going to break down the deadlines, the limits, the money moves that you are not going to want to miss, and a few spicy little strategies that people don't often talk about, but they absolutely should be. So whether you're a business owner trying to cut down your liability, you're a W-2 high income earner, wondering why your paycheck hates you and why you're giving 35% of your paycheck away to the IRS at the end of the year or throughout the year. A side hustler maybe who swears they'll organize their books next month or next year when they make more money, however that looks. Or just a parent trying to not accidentally donate half of the income to the IRS so they actually have money to invest in their children's future. So if you're any of those things above, this episode is for you. All right, everyone, let's get into it. The biggest mistake that I see people make at year end specifically, I'm going to start off with the truth bomb that no one really likes to hear, but it's important. Most people are not thinking about taxes until, drumroll please, tax season. April 15th or March 15th, depending on how you're structured and what you're structured for. It's cute, but it's also financially reckless. You're not doing anything for yourself or your family or building your own wealth. Year end is where the real savings is happening if you haven't already been doing it throughout the year. It's not in April when you're panicking at Starbucks saying, I need another coffee because I have to get something in, whether it's an extension, a payment, or just nothing at all, just additional stress. So let's go through the moves that are actually going to make a difference in your life, your business, your stress level, and your wallet. We're going to max out free money retirement accounts. I know people don't love this. Listen, you cannot tell me you're trying to build wealth if you refuse to touch the literal tax shelters that are built for you, though. Here's what you can put away in 2025 legally if cash flow allows for it. 401k is $23,500 or $30,500 if you're in the I'm 50 and above, don't talk to me before 9 a.m. bracket. Or if you're even above that and you're in the 5 a.m. wake up bracket, you absolutely can be utilizing this catch-up method too. Simple IRA is $16,000-ish. SEP IRA $69,000 is basically the amount you're allowed to use as a compensation if you're making that or above, and use 25% of that as a contribution. You can obviously contribute to your solo 401k. You can max it out at $69,000. HSA is $4,150 for individual and $8,300 for families. And what about HSAs? This is one of the most mixed things, but it's the holy grail of tax accounts. Tax deductible going in, tax-free growing, and tax-free coming out for any medical expenses, even the fun ones like Botox or cosmetic surgeries. And it's safe. It saves you money. I want you to think of the HSA account as kind of the marriage material type of position here. It's one of those accounts that is safe and it's going to continue growing and it's going to help you and roll over year after year, even if 1 year doesn't permit using it. So I'm going to give you an example here. One of my clients casually threw an extra $7,000 into her 401k before year end. Didn't change her lifestyle at all. Didn't eat ramen, nothing different. It was sitting in her savings account growing a good, $100 max within her year total in interest. It saved her, though, almost $2,000 in taxes, absolutely instantly, just with that one move alone. That's an adult version of fighting the $100 bill in your coat from last winter when you're pulling everything out because it's starting to get cold. All right, business owners, this next section here that we're going to go through, it's for you. Listen up. If you are a business, this next part could literally change your tax bill by so much money. Some say you should charge admission for this section, while those of you who've been here long enough or listening even just a little bit will say I'm a broken record when it comes to this one. But I'll let you decide here. For those of you who are new, I want to jump into a few things that every business owner should be doing, which with one of my absolute favorites that I continue to preach again and again is paying your kids. But we want to do it legally, so check back to any prior episodes if you don't know what I'm talking about here. But yes, you can pay your kids legally. Up to $15,750 tax-free as of 2025, per kid even. No, you cannot pay them for being your kid. They actually have to be doing something for your business. But I want you to think modeling for content, helping with admin tasks, producing different reports for you if they're old enough, product testing, social media photos, content creation, shredding, filing, organizing, opening mail. They truly love to be involved in you and your business and learning what you do. It's teaching them valuable things, also work ethic, but you're also deducting taxes from your business. You're shifting the wealth from one position to another, but not paying any taxes on it on either side. Everyone wins. I'll give you an example from last week. One of my dance studio clients put their 2 daughters onto payroll for actual modeling work. It was posted to their social media accounts. They saved $6,000 in taxes with just that one move. On top of that, they actually invested this into IRA accounts. So their Roths are growing. Their kids now have retirement accounts before high school even begins. You can make this play regardless of what your cash flow situation looks like. So really, check out our prior episodes if this seems foreign to you at all. Let's jump through some sexy topics that people always love to talk about, specifically in the social media realm. This is vehicles, equipment, and kind of just how you're going to write all of this off. So buckle up, literally, because we're going to jump into the section that TikTok has absolutely butchered beyond recognition, and I don't even know how to sort through it anymore. But this is section 179, bonus depreciation, aka how to turn tax panic into a brand new vehicle or a G-Wagon. If you do it legally, yes, but a lot of people don't. Here's what we want to look at. So bonus depreciation is still 60% allotted as of 2025. But Section 179 is alive, it's thriving, it's amazing, and definitely I recommend using it. But literally out here it's paying people's car notes, like sugar daddies with an EIN in a lot of situations. If you use a vehicle for actual business, not just rolling up to a Pilates class, this is the thing that's going to drop your taxable income faster than your ex drops his responsibilities most days. But here's how it works, for real, not the TikTok, pretend CPA style, or what you found on ChatGPT version. Section 179 actually lets you expense the cost today, not over the 5 years as depreciation typically is. Normally, when you buy a business vehicle, the IRS makes you deduct it slowly. Tiny little chunks over several years, typically 5 for a vehicle. It's great, but it's helpful when you're starting a massive year-end tax bill and you don't want to just start sending money on things you don't need. Section 179 says no waiting, deduct the cost of this year. Right now, it does not matter when you buy it, but right now you're deducting the full cost of the vehicle if it's used for your business, regardless of how you're buying it, whether it's through a loan, whether it is cash buyout, however that is. The business use has to be more than 50% though. This is the test everyone thinks they can manifest into existence, but listen, the IRS doesn't care about the vision board or what makes you feel good going into your appointments. To qualify, you must use the over 50% for actual business activities like driving to a job site, meeting with clients, going to networking meetings, hauling equipment around, transporting inventory, running business operations, going to check out new locations, open houses if you're a realtor, anything like that would work. School drop-off, grocery shopping, emotional support, meetings with your bestie, getting happy hour, any of that stuff. If it's not at all business related, doesn't count. You can still absolutely use this. But again, over 50% needs to be for actual business activities. So the vehicle type also matters here. Heavy SUVs and trucks over 6,000 pounds get the biggest benefit here. So if you're looking for a vehicle, definitely look and see if that qualifies or if getting an upgrade or a different package would make that qualification. Because if so, and it's a small difference in price, it's definitely worth taking a look at. So again, heavy SUVs, over 6,000 pounds, think Tahoes, Escalades, G-Wagons, F-250s, Range Rovers, Lariats, Sprinter vans. Any of these are going to qualify for that 100% of the purchase price under Section 179 bonus depreciation. So again, these qualify for the up to 100% of the purchase price under 179, plus the bonus depreciation you can add on top of it. The cute little sedan, it's still deductible, but there's limits there. So you must place it in service before year end. This is the part that a lot of people forget. You have to actually buy it. So papers have to be signed, keys, ownership title has to be technically in your name, even if you haven't picked the vehicle up. But you need to start using it for business before December 31st. So sign the paperwork, drive it off the lot, bring it back if you need upgrades, tinted windows, if you need to get the upgraded tires, the lift kit, any of that stuff. You want to make sure to bring it back after. Take it somewhere, take it for a business trip, to take a networking meeting, anything like that. I'm thinking about getting a truck next year. Deduction will count next year, but it's not going to count this year. So again, that 12/31 deadline is so big here. You need to be able to actually use it for business before that 12/31 deadline. You still need to track mileage or keep a log of some sort. A lot of people mess this up. They think, okay, now that I own this truck and we've deducted it all, it doesn't matter. I'm running every expense. I'm going to car washes. I am going to get new tires. I'm getting a wrap on the vehicle. I'm getting vinyl with my logo on it. I'm getting oil changes done. Any of those things, yes, they're still deductible and they're being caused as a deduction on your business, but you're still having to track mileage. A simple mileage app does the track most of the time. So you can do that. You can do a roundup at year end, whatever that looks like for your situation and how much you're driving and how much you're using it for personal is going to be a big factor here. But the IRS does love the way you love your returns at Nordstrom, maybe, or the way you love to see that account grow from 100,000 to 100 million, hopefully in the next 5 years. So we want to take a look at all of that as we continue. The deduction is going to lower your taxable income here too. So buying that vehicle is not only going to save you money, but the deduction is lowering your taxable income, which is lowering the taxes that you're going to have to pay at year end or the refund you're going to get. That's freeing up cash for right now too. That can feel like the IRS is paying your car note for you, essentially. So an example of this would say, like, let's say you buy a $70,000 truck. You qualify for the Section 179. It's over 6,000 pounds. You deduct the full 70K this year. If you're in a 30% tax bracket combined with federal and state, that deduction saves you about, I don't know, $20,000 to $22,000 in taxes with that alone. That $22,000 that's kept in cash now, yeah, that's more than a year's worth of truck payments alone. So now you have a new truck that you just paid for itself, whether money's come out of your account or not, because a lot of people are loaning these vehicles to themselves at zero for the first 12 months. It's an incredible move. I want to go into a few other favorite year-end strategies a lot of people know about, but most people have never actually heard about too, surprisingly enough. These are strategies that make your tax bill drop so hard that truly it should be illegal, but it's actually incentivized by the IRS and the government. It's not, don't worry, it is so approved, so we are good here. The Augusta Rule, this one is great for everyone that owns a home. You can rent your home to your business for up to 14 days per year, and this is going to be completely tax-free. Yes, tax-free. The business gets the deduction. You get income with zero tax on it from the personal standpoint. This is going to be great. You can do it for strategy meetings. You can do it for client events. You can do it for holiday parties since we're coming up in the holidays. You can do this for branding. You can do it for photo shoots. There's so many different things you can do it for, but you're also just taking $14,000, moving it from your business income to yourself personally. And that doesn't have to be recorded here. So you are moving your income from one place to another, benefiting it in all aspects. I don't know why anyone wouldn't do it. So for example, a client rented his home to his business planning for sessions and events. He did actually do a photo shoot this year, I believe, too. And he made $14,000. It's completely tax-free again, personally. But this is how the rich people are getting richer. You can use that $14,000 in any way you want, but the bonus would be to actually invest this back, whether it's into another business, into the business you're currently using. It could be into actual investments, into your retirement. Any of these things are so key here. By understanding the rules and not breaking them, you're going to save millions, and just using them is going to create a long-term plan for you to potentially even retire one day from. Another one that we hear a lot about, and it's one of my favorites, but also a very misused one, is charitable giving. But I want you guys to be thinking more strategically if you're not already here. If you actually want a tax deduction, you need to treat it as a strategy, not a feeling, not I did something really great today. But I want you to look at your own situation and determine how much you can give for a tax deduction, how much you can give just out of the goodness of your heart, to who you should be giving it to, and when, if you're doing it for a financial strategy. You need to know your tax bracket. This is going to tell you the ROI for what you're giving and what you're able to use as a write-off or a liability standpoint. Charitable giving reduces your taxable income, so knowing your bracket helps you understand this. If you're in the 22% tax bracket, a $10,000 donation really costs you $7,800. Again, you're doing a great thing and you should absolutely be doing this, but you're, from a tax perspective, doing this decision. you're not actually saving anything outside of that initial $2,200. If you're in, let's say, a 35% tax bracket, that same donation costs you $6,500. So again, the higher income, the bigger tax impact you have, but this is why the wealthy people are giving strategically, and they're able to give more and more and more, but to a way that's actually giving back to them too. So again, depending on what you're trying to do here and what your goals are, it's something to be looking at specifically for those who are just looking to donate for that write-off. So we want the IRS to be subsidizing part of their generosity, just like they are to you, but you have to do it by their rules. So next time you're going to donate, specifically if you're doing it from a strategic standpoint, so I want you guys to ask yourself, do you itemize or take the standard deduction? This is one of the most important questions and almost no one is asking it. You only get charitable deductions as a tax deduction if you're itemizing it correctly. So if your standard deduction is higher than your itemized deductions, nothing moves the needle from here. Your itemized deductions include mortgage, interest, property taxes, state and local tax up to $10K, charitable giving, medical expenses, things like that. So if you're able to hit that based on the thresholds, will my itemized deductions beat the standard deduction this year? If not, you may need to group donations together into one big year so you can itemize, called bunching, if you're in that position to need to limit those liabilities and shift that income. But you need to be deciding what type of giving makes the most sense for your tax position. So one of those would be cash donations. They're simple, good for lower amounts, but just remember you must be qualified as a charity, a legal charity through the IRS too, to make this work as a tax deduction. Appreciated stock or crypto donations are great too. This is where a lot of taxpayers are winning right now. You avoid the capital gains tax and get a deduction for the full market value, which is incredible. But you have to ask yourself, do I have investments that went up in value? Would getting them reduce taxes more than selling? Another one is donor advised funds. A lot of people know this as DAF, perfect for higher income business owners or anyone with big income spikes this year. A DAF allows you to make a larger donation this year, take the full deduction now, but then decide later, even years later, which charities actually are going to receive that money from you. So you can make this as you go and as you continue to grow and whatever that ends up leading you to. So this is ideal when you need a deduction right now this year and didn't make another plan, but you don't know yet where you want to give and what that's leading you towards. So again, remember, ask yourself, do I expect higher income this year? Should I front load my giving in some capacity? How should you give and how much should you give is so important. So there's really no universal number. Again, a lot of this is on what your heart tells you to do, but from a tax standpoint, there are guidelines here that are based on tax strategy. If you want to maximize tax impact, what you need to do is give enough push to your itemized deductions over that standard deduction, and the limits increase exponentially. That's usually the tipping point where donations start to lower your tax bracket in a meaningful way. If you're offsetting a higher income year, for example, this is where the giving becomes more powerful, like a big commissions year. You sold maybe a property, a massive business profit. You sold a business potentially. You can actually use that charitable giving, especially via a DAF, to reduce your taxable income dramatically here. If you're just starting, give what feels right, but make sure to document everything. This is so important in documentation. Choosing the right charities, the IRS doesn't accept vibes or they made a really good pitch as a tax deduction. That's important to remember because a lot of us get sucked into that, myself included. I love to even donate to the person standing outside of Target. But again, that is not going to be something that's at all a savings in tax. I get to feel great about it and it's an awesome thing to do. You should. I encourage that strongly. But it's not at all going to save you in taxes. And a lot of people have the misconception that it will. So I want everyone to be remembering that when they're donating and maybe decide where you're going to spend that money each year. To qualify them as a qualified organization, it must be a 501c3. So you could check this on the IRS Charity Lookup tool, the charity's website. Most of them actually list their EIN and address, so you don't have to necessarily get that. Though most of these charities are going to send you a statement at the end of the year with exactly what you provided as far as your donation. But it's also going to provide you with all of their information, what tax year that was being applied to, etc. So is this organization actually a qualified charity, or am I just Venmoing something or providing them money from outside of Target because they made a good case to me? So like I said before, donating is great, but better from a tax perspective is going to be even documenting all of what you're doing. So for charitable giving, this is extra important. So you want to make sure you have receipts, dates, amounts, who it was to, and written acknowledgement from the contributions if they're over $250. The IRS does not get credit for, I promise I donated, or I stopped by and sent someone something from Target or Goodwill or wherever that is. It doesn't work that way. But Goodwill is absolutely one you should be doing. Everyone donates in some capacity, whether it's to Goodwill or whatever that is. And the limits are typically between $400 and $800 per year. And that, again, you don't have to have proof of receipt. This is from things you've donated from Goodwill. You get their little handwritten checkout receipt that you fill out yourself. But realistically, everyone should be claiming that, and everyone should be donating to these things and making sure that if you have something to give, that it's going to someone who deserves it. Or at least is there, but you're also then taking and capitalizing on that. So the bottom line here is strategic giving is not all the things I listed above. It's knowing your bracket, knowing how to itemize, knowing what you're donating and where you're donating it to. Know when to give and make sure to document it. Make sure you're knowing, are we taking this as a federal deduction or through your state as a deduction? Charitable giving is one of those few deductions that lets you do something really great while reducing your tax bill. So it's a double win here, but only when you're doing it intentionally. So estimated taxes. No one likes this, but don't get surprised, punched by penalties if you're in a position that would need it. You need to follow special rules, but specifically the safe harbor rules. Pay 110% of last year's tax if you made over $150,000. I recommend that so much. Or 90% of this year's tax bill if you know that and are doing the planning up front. Or, again, if you owe less than $1,000. This is how you avoid penalties completely. Penalty letters coming in the mail that arrive in April and also just make you feel bad even if they're small. So, again, I want you to recap, but give you finally a few little sneaky but legal moves I wish that more people knew before closing out here. Before end of year, if you're in a position you're like, oh my gosh, I don't know what to do. Maybe you need a new vehicle and you bought one. Maybe you don't need so much expenses as a new vehicle. There's several other things you can do. One of those is prepaying expenses. If you're a cash basis company, which a lot of service-based companies, but also not, if they're smaller, then you need to be looking at, hey, can I prepay my rent, software, contractors, insurance, supplies? So maybe you do have a net 30, or you call your renter and you say, hey, can I actually go ahead and pay you a month in advance? That could knock off $10,000 alone of prepaid expenses. That comes off this year's expenses. And again, with more planning next year, you might not be in that same position, which is incredible. This can go for supplies, insurance, contractors, software, anything, like I said. It can even go for your employees if they're willing to do so themselves and take the liability on that point. One client of mine actually prepaid over $18,000 before year end and dropped their taxable income by so much. It brought them into a different tax bracket and was life-changing in the sense of what they were able to do to reinvest. Another one is clean books. These are such an underrated thing, but they cause so many greater, bigger deductions if they're being looked at correctly. If your books are chaos, I cannot save you. No CPA can save you. No strategist can save you. A bookkeeper is so underrated, but one of the best things ever. If your books are chaos, again, no one can help you. You don't understand the roadmap you're about to go on. Not because people don't want to, not because you don't want to. It's because your tax planning is only as good as the map you're about to plan on. If they're messy, you're probably overpaying in taxes by far, but you're also probably getting different deduction codes and percentages on things that potentially could be categorized differently. You're probably overpaying, like I said, but it's a double loss for you to begin with because you're missing out on the planning feature that it's meant for. So again, before we wrap up here today, I want to do a really quick lightning round of Q&A. So let me think of a few things since I didn't have this fully prepared beforehand, but okay. Something I went through today with a client. Should I buy something just for the write-off? I am really strapped on cash right now and I don't have the money, but I don't want to have to pay $7,000 in taxes this year or $17,000. What do I do? Do I buy a truck? Do I buy equipment? Do I do all of these different things that are just expending cash that's not there? The answer would be no. A tax strategy does not cure impulsive spending. It does not actually help your financial situation if you're spending money with no purpose. Again, there's so many strategies that can just shift your income versus actually spending additional funds. So if you're in that position, there's so many things we can do. But no, I do not recommend just buying expensive things because you don't want to pay a tax bill. Let's think another one. Holiday parties, are those deductible? Absolutely. Employee or client parties, networking, any of those things are absolutely going to be deductible. Girls' night out, no. But if it's your clients or prospective clients, absolutely potential for a deduction. Another one would be, can I write off a Christmas gift? Client gifts, absolutely. Prospective client gifts, yes. Employee gifts, yes, if they are done right. But again, this is such a nominal thing. The limit is $25 per person per year. So again, your gift has to stick really small. Gift cards are great in this asset, but again, small. $25 limit per year per person. This is employees and clients. Another great one is, can I bonus myself? Should I bonus myself? Absolutely, you should. Run it through payroll if you're an S Corp though. Your S Corp doesn't magically know what to do with these cash transfers. And if you are just giving yourself a distribution, it's not actually taking away from your taxable income. So keep that in mind here. So year end, again, is where the magic happens. And I hope everyone is capitalizing on that and feeling as great as we are with the elf on the shelf and everything coming up with the holidays here. But this is where people who plan save thousands and thousands and thousands of dollars, and everyone should be. And people who don't end up writing the IRS a check that they never meant to donate to the IRS. If you take anything from today, let it be this. The IRS doesn't reward perfection. They reward preparation and documentation. The fact that you're here listening, learning, and actually giving a damn about what might happen in your tax situation means you're already 90% above the curve of most taxpayers who wake up on April like, shit, what do I owe? And when do I owe it? And how? And do I have penalties here? So before we wrap up, I'm going to give you one last example. I had a client this year. She was a W-2 income earner around $280K, if I'm remembering correctly, but she wasn't planning to max out her 401k at all. She was really, really excited about retirement and had the cash flow to do so. But we squeezed in just an extra $7,000 right before December 31st, and her federal liability dropped to less than $2,000, which is insane. Same job, same paycheck, same life. It's just a smarter way of utilizing that money. And it's also planning for her retirement, to build money, to build wealth for when she's ready to be done. And that's really the whole point of this show and the whole point of how it's supposed to go. If you're not contributing, if you're not planning, you're not preparing, you're not saving money, you're just choosing to pay taxes instead of paying yourself that, or restructuring it to make it so it can pay yourself. I know it sounds really rough, but it's truthful. So if you need help cleaning up your books, tightening up your strategy, running any sort of projections, or building out a tax plan, it doesn't involve some sort of horrible situation or selling a kidney on Craigslist, but you know where to find us. This is Spicy Takes and Tax Breaks. I'm Aubree Denekamp, the host here, and I'll see you next week with more ways to legally and lovingly, strategically, keep more money in your pocket instead of the IRS's hands. And next week, we're going to go into the legal way of structuring it with one of my favorite business attorneys out there. So looking forward to seeing you then. Again, hit follow, subscribe, and like, and keep looking out for ways to save money.